take the least amount of insurance you can get away with, according to the IRS, and then put in the most money or premium the IRS allows, and this will turn into a tax-free cash cow. In this educational episode, I'm going to address how do you or how should you buy indexed universal life. So I'm Doug Andrew, and I've been helping thousands of people optimize assets and minimize taxes now for about 5 decades. I'm 70 years old. I started in 1974. If you've watched very many of my educational episodes on this channel, you'll soon learn that one of my favorite financial vehicles, where you can accumulate your money totally income tax free. You can turn on tax-free income. You don't have to wait till you're 59 and a half. But for retirement, it knocks the socks off of most IRAs and 401ks. And at the end of the day, when you die, anything you leave behind blossoms and transfers income tax free. And this is under 3 sections of the Internal Revenue Code. So when I get asked the question, how should I buy indexed universal life? Thank you for this question, because unfortunately, probably 99% of agents, life insurance agents, who sell IUL do not know how to structure it correctly and fund it properly, so it performs at the highest net internal rate of return. They're never trained that. Or they're told by their superiors, oh, no, level is the devil. You don't ever use the level death benefit. And I'm going, oh, my heavens. These people do not get it. They don't know what they don't know. And it's unfortunate. That's why I've trained over 5,000 financial advisors, CPAs, and tax attorneys. And I have currently over 1,000 IUL agents who belong to a coalition, a network that I mentor on a weekly basis called IUL Insiders. They know how to do it correctly. And what's the difference? At the end of the day, if an agent who does not understand what they're doing, they have way more insurance on the account than they needed to. What does that mean? It means that even if the IUL averaged 7% because they didn't know how to rebalance and reallocate every year, you're going to be lucky to net 3 or 4% because the cost of insurance gobbled up half of your interest. Unfortunately, that's the most common mistake I see made by IUL agents who don't get it. You ought to be able to put in your money and actually have the least amount of insurance the IRS will let you get away with, and it turns into a tax-free cash cow, and you're self-insured where your cash value equals or exceeds the death benefit, usually by the 12th year. And most of my clients are savvy people, 55 to 75 years old who understand money. And so they take the level death benefit. There's no question. The only time you use the increasing death benefit is you've got somebody in their 20s or 30s socking away, $500 a month into one of these, and then they stop funding it. Then you switch over to the level death benefit if you want the cost of the insurance to get cheaper as you get older. If you want the cost of the insurance to keep getting expensive as you get older, as Dave Ramsey assumes, then you don't ever change it. No, you want the cost of the insurance to get cheaper as you get older. So when people ask me the question, how should I buy it? Well, I would recommend you structure it or buy it for living benefits. Now, if you need it for death benefit, you can structure it, in my opinion, to outperform whole life because of the nature of it. Whole life is okay for death benefit. Yes, whole life was built for that, chassis where you have to pay a certain amount of premium, so that with these guarantees, the death benefit will never lapse if you die, at age 100. But whole life was never designed to give you a very good net internal rate of return to have tax-free income. You just ask a whole life agent to illustrate the whole life policy generating the most income as possible, so you do not outlive your money if you live to be 120 and get that number. and I don't care what the number is, let's say it's 40,000, I can probably generate 60 to 80,000 out of the same amount of cash value in an indexed universal life insurance policy. Because the use was to increase the income. I would rather have twice as much income. So you can get away with less insurance than a whole life policy to accommodate the amount of money you want to put in under IRS guidelines. So let's get back to how should you then set up your IUL. Well, under 3 tax citations, TEFRA, DEFRA, and TAMRA, you want to take the least amount of insurance the IRS will let you get away with and then put in the most money the IRS allows as fast as they allow. This is determined or dictated by the Tax Equity Fiscal Responsibility Act of 1982. It spells the acronym TEFRA, and also the Deficit Reduction Act of 1984, DEFRA. The TEFRA, DEFRA tax citations dictate the minimum amount of insurance required based upon the person's age, gender, and health. And the more unhealthy they are, if they can still qualify and even be rated, you can even squeeze down the death benefit so that if your objective is to earn 11 and net 10 like I have, then you can get away with less insurance. If you are uninsurable, you use a surrogate, your spouse, your kids, your grandkids, because it's the owner of the insurance contract that gets all the tax-free income. But you just don't assume that, oh, I'm going to take this out on my kids that are 20 years old because the insurance is cheaper. No, it isn't. They have to have more insurance than you do. The 20-year-old can earn 11 at net 10, but you can be 78 years old and 1 foot in the grave, so to speak, and be rated Table D, squeeze down the death benefit under TEFRA and DEFRA, and you can earn 11 and net 10 just like a 20-year-old. The cost of the insurance is the same, even though you're 78 years old and rated 100% more than a normal 78-year-old, Table D. You can't believe how many agents don't understand this, because you're able to squeeze down the death benefit and take the least amount of insurance the IRS will let you get away with. So let's take an age 60-year-old that's in good health. Under TEFRA and DEFRA, if you wanted to reposition 500 grand, the least amount of insurance now is about double that, $1 million. Your objective isn't how much insurance can I get for 500 grand? No, people don't come to me saying, how much insurance can I get for 500 grand? They want to know the least amount of insurance required by the TEFRA and DEFRA tax citations so that their $500,000 they want to put in this will double to $1 million, to $2 million, to $4 million, to $8 million, as fast as possible. So the least amount of insurance at age 60 under TEFRA and DEFRA is $1 million. Now, if your objective is net internal rate of return, you structure it so that your money will grow tax-free at the best net internal rate of return. You want the cost of insurance to get cheaper every year, not more expensive. Most financial advisors like Dave Ramsey and Susie Orman, they don't even understand this because they're thinking that the life insurance is going to cost more as you get older because they're thinking of annual renewable term, and most insurance policies have that annual renewable term in there. But if you're structuring it for living benefits, every dollar you put into it and all the interest you're earning can qualify as part of the death benefit. So the actual net amount at risk is getting less, and the insurance company is charging you less every single year until the insurance is free because you are self-insured. Your cash value equaled or exceeded the death benefit within 12 years. So how should you structure it? Let's go back to the 60-year-old. If you wanted to put in 500 grand, you can't put it in all at once. First of all, you'd violate TAMRA. Your money would only grow tax deferred. Then if you want to turn on income, now you have to pay tax. It's tax LIFO, last in, first out, like an annuity. Most people come to me, they want tax-free income. So they have to jump through another hoop in the Internal Revenue Code called TAMRA, the Technical and Miscellaneous Revenue Act of 1988. See, the banks and brokerage firms, they couldn't compete with these. They were safer, paying higher interest, and they were tax-free, and they blossomed when you died. They didn't, theirs wouldn't do that. So they wanted to slow the flow, but they didn't want to kill these because this is where they put some of their money. Banks and credit unions, in fact, put 30 to 40% of their Tier 1 assets, those are assets that they must have on hand, liquid and safe, in case of a run on the bank. Okay, guess where they put it? In insurance companies, usually in the form of BOLI, bank-owned life insurance. They borrow your money and pay you 1% interest. They turn around and make 5. How much more is 5 than 1? Don't say 4. It's 5 times. They pay $10,000 a year in interest to borrow OPM, other people's money. On $1 million, they pay 10 grand, and they make 50,000 by putting it into insurance with insurance companies. That's a 500% return. It's actually an infinite rate of return because it would only be 500% if it was on their money. They're doing it on other people's money, so it's actually an infinite rate of return. That's another subject. We have a lot of educational episodes on how to become your own banker. Let's get back to this. If I want to have the cost of insurance get cheaper so that I structure it correctly to accumulate my money tax-free and then be able to access that money tax-free, I want to then have my cash value be counted as part of the death benefit. I want the level death benefit. So when I put in $100,000 a year, if I put in $100,000 the first day of the first year, the first day of the second year and third year, finally the fifth deposit to comply with TAMRA, it happens in 4 years and 1 day, and now I have my $500,000 in there. But my original death benefit was $1 million. Now, if I die, they're only going to pay out $1 million if I do it the smart way because I want to have the insurance get cheaper as I get older. And so the net amount at risk is only $500,000 once I have $500,000 in the policy, because $500,000 of $1 million death benefit is now my money. The insurance company is only charging me for half as much insurance as they did 4 years earlier, even though I'm 5 years older or whatever. Is this making sense? Well, based on average rates of return, 9.6 divided into the rule of 72, that $500,000 now is going to double in about 7.5 years. By the 12th year on most of the policies that many of my clients have, their cash value equals the death benefit. What's the cost for insurance now? 0. There is no net amount at risk, except Tefra Defra says that if you happen to die, the insurance company must pay 5% more out in a death benefit tax-free than the cash value. But they're only charging you for that $50,000. If I died when I had $1 million in there, the death benefit's $1,050,000. When $1 million in another 7.5 years doubles to $2 million, if I die, they pay out $2.1 million. But they're only charging me for $100,000 net amount at risk because $2 million is my own money. Now, that's how you should structure your IUL, so that the cost of the insurance gets cheaper as you get older, and so you're self-insured as soon as possible, maybe as early as 12 years into it, or 20 years into it. If you follow the buy term, invest the difference crowd, it's going to take you 30 years before your money equals the amount of life insurance so that you can get rid of it. And then people don't want to get rid of it because because of inflation, you now need both if you happen to die. And the money in a tax-deferred IRA or 401k is not all your money, yet only 2/3 of that is your money. It is not the smart way to go. Okay. So if you want to learn more about how to structure it correctly, I would recommend you study this book, and I would recommend that any IUL agent understands the answers to 14 questions in this book. If they can't answer those questions off the cuff, that should be a red flag. So you can buy a copy of this on Amazon, and they're $20 plus shipping and handling. If you do that, thank you. But I'll gift you a copy free. I'll show you how to claim your free copy, but please know it's actually 2 books in one. This side is the left brain side. For those of you who make your decisions or learn logically, it has all the charts and graphs and explanations. It's 14 chapters, about 200 pages. If you're more of a right brain learner, you learn by stories. You flip it over and read this one. This is 12 chapters, about 100 pages with 62 actual client stories of how a properly structured IUL can be used as a dream solution for retirement, college funding, working capital for your business, real estate management, emergency funds, pension maximization, if you're a school teacher, police officer, a firefighter, on and on and on. If you want to use your whole brain, read both books. But you simply go to laserfund.com or click on the link below. You contribute a nominal amount towards the shipping and handling, and I'll cover the rest of that cost, and I'll pay for the book, okay? So I'll fire out a hard copy via priority mail next day. But while you're checking out getting your free copy, you may want to consider, if you like to listen and learn or watch and learn, the audio and video formats. You can also schedule or register for an educational webinar. We teach them on a regular basis. They're free. But you can even schedule an appointment online to talk to an IUL specialist, one of these IUL insiders that know how to do it right, so that they can show you some illustrations for no cost, no obligation, because I don't want you to make a mistake taking out an IUL and not having it structured correctly. So hopefully this video has helped you understand how you should set it up the right way. And I would rather earn 11 average and net 10 than have it done wrong and only earn 7 and maybe net 4. Does that make sense?